through how to use the tax withholding estimator that is located on the IRS website. There is not a whole lot that you need for this tax tool, which is free. And before we get into it, I'll kind of walk through a couple of things that you should probably know. So this is the estimator that you would need if for some reason your financial planner or your accountant or your tax expert tells you that you should look at adjusting your withholdings on a Form W-4. So your W-4 it contains the instructions that you give to your employer, telling your employer how much in taxes they're going to withhold from your paychecks and send to the IRS on your behalf. So basically, this tool estimates your federal income tax withholding as it currently stands, takes a look at a rough estimate of your tax situation, and then determines an estimated withholding amount that should work for you. So tax planning sometimes consists of making tax withholding adjustments so that you're not withholding too much tax and you get a huge refund at the end of tax season. But at the same time, you do need to withhold enough tax throughout the course of a year so that you don't have underpayment penalties. So we're trying to strive for a sweet spot. Now, what you'll need is your previous year's tax return, as well as a current pay statement for each job that either you or your spouse have. So if both you and your spouse have employment, then you probably need to have your pay stubs so you can accurately determine, how much tax is being withheld from all sources of income. And then from there, you can figure out how much you need to adjust your taxes. So finally, a couple of notes that I would go over before using the withholding estimator. If you have a pension but not a job, then you would use the Form W-4P, specifically the withholding certificate for pension or annuity payments. If you have a non-resident alien status, you probably need to use Notice 1392, which is supplemental Form W-4 instructions for non-resident aliens. And if your tax situation is too complex, like you've got long-term capital gains, you've got qualified dividends, you've got alternative minimum tax, then you probably are going to either need more sophisticated tax withholding software. You probably should be working with a tax professional and actually having a tax planning meeting throughout the course of the year. In our show notes, I'll put a link to a couple of articles we've written about the importance of tax planning as part of the financial planning process. But obviously, this estimator is for fairly straightforward tax withholding situations. So let's get into it. All right. So you can see that there are 6 different parts to this form. We'll talk about the taxpayer status, then income and current withholding, any adjustments to income, any deductions, and then any tax credits that may apply. So a couple things to note. These estimators that you can find on the IRS website, they don't keep your tax information. They don't keep any personal information about you. So you can just go in and fiddle around and play with a couple of scenarios. So what I'll do is I'll kind of walk through one scenario, and then we'll think of some hypothetical situations where we might want to go back and make some revisions. So I'm going to click Married Filing Jointly, and our hero John Doe and his wife have jobs. So once you get to this point, then you can answer, do you plan to claim dependents on your tax return? Will you be 65 or older? Will your spouse be 65 or older? Is either of you blind, and can anyone be claimed as a dependent on a tax return? This all kind of impacts some of the calculations because they in turn can impact your deductions or certain tax credit. So, so we're going to hit the next button. Now, first source of income. We'll just say that John Doe has a salaried job. It's for himself. He's had the job all year. He gets paid every 2 weeks versus twice monthly. So here's a common distinction. Every 2 weeks is known as biweekly payments. And if you get paid every 2 weeks, you get paid 26 times a year. Now that sounds very similar to twice monthly, but twice monthly is commonly referred to as semi-monthly, which means you get paid twice a month or 24 times a year. So you can, a very common mistake that people can make is selecting one when they meant the other. So just keep in mind twice monthly. I come from a military background, so we used to say that the military thanks you twice a month, whether you did your job or not, on the 1st and the 15th of every month. But you might work for an employer that pays you bi-weekly. So make sure you pay attention to that detail. In this case, John Doe gets paid twice a month, and his most recent pay period ended. We're filming this in October 2023. Let's just say that his most recent pay period was the 15th. And that also happened to be when he got paid. So what did he get per pay period? Let's just make this a nice smooth number. Let's say that he gets $3,000 per pay period. And his salary to date would be, we'll have to do a calculation if he gets $3,000 every pay period. So that would be $57,000. Based on the information provided, it looks like your annual income is $69,000. Oh, uh-oh, what if we made a mistake? Oh, it looks like it updates automatically. So just keep that in mind. We've entered that number. It looks like that is correct. And then we'll just put in a dollar amount. So every pay period, let's just say that he paid $500. And so he's been paying $500 per pay period for, let's say, $1,000 a month through September, plus once in October. And let's see, does he contribute to a 401k, health insurance? Is he getting a bonus? Let's just say he's getting a bonus of $15,000 at the end of the year. And then let's see, does he have any other sources of income? Let's go back to the top, and let's say that his wife has a second job. And now we're going to enter Jane Doe's job. She has an hourly job, and this is for her. And she's been holding that job all year. She gets paid every 2 weeks. So actually every week. Let's just say every week. And her most recent pay period ended on the 20th. And now, most of the time, your pay date is not the same as the pay period. I'm doing this for illustrative purposes. Your pay statement will actually contain information about the pay period and the pay date for that pay period. So pay attention to that. I'm using this as an example of a hypothetical, the world's best HR department that is able to turn around and process paychecks on the same day as the pay period ends, which does not exist. So let's select the option. My spouse's paycheck was a pretty good representation, mainly because I don't want to enter 2 to 3 more paychecks. So let's just say that she earns, well, let's just say she earns $600 a week. and she's been doing this every week. So let's just say that we're at about week 40. So she's probably earned about $24,000. Yep, it looks good that she probably earned about 27,000. So we're going to say that she pays $100 a pay period, and we'll just estimate that she's paid about $4,000. Now, it asks you several questions: sources of income, withholding from other sources. So you can click on these question marks, and it might be things like, hey, some of these payers of other income types may have withheld federal income tax. Maybe you made estimated payments, which you can do directly on the IRS website. You can also send a copy of, you can send a check to the IRS with a pay voucher enclosed. So you can do either or. If you have, you would enter that amount. Now we're going to enter any adjustments. Now, adjustments to income are different from deductions from income. So anything that's on this line, remember, is an adjustment to income. It will probably be, it's known as, or it used to be known as a top of the, like above the line deduction, because it used to be above a line on the Form 1040 that below the line was the adjusted gross income, and then any other deductions below the line meant that they did not make any adjustments to your adjusted gross income. So hypothetically, let's say that you're at about $60,000 of AGI, or adjusted gross income. If you went back and entered a student loan interest deduction of $1,000, that $60,000 AGI would now become $59,000. So we're going to enter that. Let's just say $1,000. And then, of course, our folks contributed to traditional IRAs. Let's just say they contributed a total of $10,000 to IRAs. So this automatically calculates the adjustments to income, and then we'll go forward. And let's just say that we're good with the standard deduction. However, you can go through and estimate your itemized deduction. So if you have a house with a big mortgage, if you have lots of medical and dental expenses, if you live in a state with lots of either real estate tax or income tax, or you made a lot of significant purchases, up to $10,000 of the state and local taxes that you paid during the course of the year may be deductible on IRS Schedule A. If you make charitable contributions. And you can always click these question marks to see what additional information there is and where else you can go to learn more about that. So let's just say that we kind of go through this, but our standard deduction, it probably is the best deal going. So we're just going to go ahead and use the standard deduction. So now we're going to see if they're able to claim any tax credits. We'll say that John Doe is 45 and that Jane Doe is 45. You have at least one dependent. Let's see. Let's just say that our dependent is 10. We have one person, and let's just say that we spent a total of $2,000 on work-related child care expenses. And then let's just say that we think we might be eligible for the earned income credit. We're not sure. So adoption tax credit. So we didn't adopt a child. We'll skip this one. But and then there are lots of other information fields and this is information you would possibly pull from your prior year tax return or from a tax planner. So educational credit, the American Opportunity Tax Credit, like if someone was going back to school, they'd be able to claim some of these credits. The retirement savings credit, which you can make contributions. It's also known as a saver's credit. You would file Schedule R, generally for lower income people that are trying to save for retirement. Homeowner, like residential energy credits, mortgage interest credits. So if there are any of these credits that you want to know more about, you can take a closer look. So we're going to go back to the top, and I think other than the child-related credit, I think we're good. So now it looks like we might be withholding a little too much money. So we've got a $13,961 refund coming in, and then you can get specific instructions on how to complete your W-4. You can download a pre-filled version of a W-4. You can step by step figure out how to claim other deductions and things of that nature. So like, this is a pretty good outcome for you, just to make sure that you are properly withholding taxes. Now, if you submit your new W-4 and then now John Doe's spouse may need to complete W-4 as well. So these are estimates, obviously, and you do want to make sure that you're kind of doing this either with a professional who can walk you step by step through a process known as tax planning. Tax planning usually occurs, say, between June and September of a tax year. That way, if you notice that you're going off track, or you have way too much income, or way too much or too little withholdings, you can make adjustments in time. You can send an estimated payment in time to avoid penalties and to kind of make sure that you're on track for the rest of the year. So this can be a very useful tool. And oh, by the way, you can go back and check out all of this information. Oh, let's double check this. Let's go double check this tax credit situation. Maybe we're not eligible. Maybe we missed some itemized deductions. Maybe we missed some adjustments to income, right? Like, you can do all of these things simply by going through this tax estimator. And then, of course, you can print everything if you wanted to. Let's download the pre-filled Form W-4. And oh, looky here. All we have to do is type in John Doe's information. Oh, there are some limitations here. I seem to not be able to hit the space bar, but you get the intention, right? So we've already clicked married filing jointly. We, are claiming dependents. We're, making these adjustments to our deductions, and then we're going to sign here. So we've already done the hard work simply by completing this, and the IRS just spits out a pre-filled form, and then you can do the same thing for John Doe's wife. So that's all we have on this video. It's a great tool, the tax withholding estimator, and if you have any questions, please feel free to hit me up in the show notes. If you want to run another video with hypothetical scenarios on how to handle specific tax situations, please hit me up. And we'll put links to some of our tax planning articles, as well as other articles we've written about some of the forms and deductions mentioned here. So like I said, if you have any questions, please hit us up. If you like our YouTube videos, please subscribe to our channel. And as always, if you have any questions, please don't hesitate to ask. Thank you very much and have a great day.